Hello everybody, today's video is about gold and silver, specifically investment in gold and silver, and the outlook for, well, the rest of the year, but mainly for 2026. Matt Penfold here from Fiduciary Wealth Management, here with my co-director Paul Correa. And for those who followed our videos before, you may remember or may know that we and here is where I give credit to Paul, were very bullish on the gold price over the last few years, and gold and silver has got, well, gold specifically, but you know, silver comes with it, has a lot more media. People are talking about it a lot more because of the increase in price. Gold is what is up about 56% in the last year. Silver very similar, around 62%. Some people may think, okay, they've gone up that high. Have I missed the boat as an investment opportunity? So Paul, are they correct? And what's our kind of projection or what is in the future for gold and silver?
Thank you, Matt. Well, as you know, during COVID, and thank you for that introduction. We came out saying that people should be holding gold and silver, gold in particular, long term. And okay, our timing, we were perhaps ahead of the market because the market doesn't follow the economy as close. It's not as closely aligned as we would like. But the reality is that we were completely right in our prognosis that gold and silver could only go up in value and quite significantly. And I think when we came out, from memory, I think gold was around 1,600 an ounce, and silver was about $11 to $15 an ounce. And you've seen how far it's gone since then. I know a lot of our clients were hugely disappointed with performance over a couple of years because, as I said, sometimes, the markets don't follow economic reality. They're not aligned. The economy is not aligned to the market. The markets have, they operate under a different set of rules. So yeah, gold and silver underperformed, but our view didn't change. We came out and we said, gold will reach $3,000 based on the facts then. And I think it's peaked at 4,400. It's about 4,000 today or 4,100. So if anything, we were a bit conservative in our outlook, but in all truth, Matt, a lot has happened since COVID. And there've been other driving factors that did not exist when we did our research and that are at play today that justify a much higher gold price. At the time in 2021, we're talking about geopolitics, about fiscal, monetary and fiscal risks, and the war in Ukraine and Ukraine being the breadbasket of Europe, how that impacted food prices. We went from high interest rates to zero, and then they went up again, and there was all that moving the market. But no, I think our price of 3,000 was on the conservative side. I think what are the structural drivers today? I think that's probably what our viewers want to know. I think central banks are continuing to run budget deficits. All Western nations are running budget deficits. So they've got large national debt, but because they're running deficits, and these are not cyclical deficits, economies go through, just a second, economies go through cycles. As you know, Matt, they go through, or they used to go, 30 years ago, 7-year cycles of boom and bust. And then there's a cyclical deficit during the past years because, Keynesian monetary policy that in times of recession, you increase your government expenditure to make up and to resuscitate the economy, and that was quite normal for a century. But now cycles are shorter, and um, the deficits that we're seeing are not cyclical; they are structural, and that is the danger. It's a structural deficit, and they're not addressing the underlying issue. So I'll give you the US as an example, as a prime example.
Of course.
They've got a national debt of $37 trillion. The interest payments on the national debt is $1 trillion a year. It's like the third or the fourth largest area of expenditure, $1 trillion, right? This is why Trump wants to put in his lackeys, his people into the Federal Reserve to lower interest rates to as low as possible, because it's costing the US exchequer, the US government is costing them a lot of money, 1 trillion. And then they've got the structural deficits, which are running at about 1.8 trillion. So between the structural deficits and the interest on the national debt, that's like 3 trillion. So if your national debt is 37 trillion and it's growing every year at the rate of 3 trillion and compounding, can you imagine what it will be in 2030? It is completely unsustainable. Hence, Trump is trying to push interest rates back to zero and put people there who are essentially people who will do as they're told. And they're trying to rules, but they're not addressing the underlying issue. And the underlying issue is, I know we are slightly diverting, but it's all relevant. They are trying to push rates lower, and then there's other factors coming into play. There's the fact that, and it's a shame that we haven't got graphs to share, but if you look at most countries, their holdings of U.S. Treasuries are declining very rapidly. So there's evidence, anecdotal evidence, hard evidence, I would say, that a lot of countries are divesting from US Treasuries and increasing their gold reserves. That is driving the price higher. Now, if the US keeps running those deficits and no one is buying the US Treasuries to fund the deficits, then the Federal Reserve has to act as the buyer of last resort and buy their own treasuries, expanding their balance sheet as a result. And that in turn means that there's more money in the financial system, creating inflation again in the US. So most market analysts are thinking, okay, yes, the price is now for much than we anticipated, but those deficits are going to play a part, and no one's buying the treasuries. So the only way to fund our structural deficits is for the Federal Reserve at some point to act as the buyer of last resort, which is inflationary because it's increasing the money supply. And the markets know that that the trend is very clear. All the BRIC countries are disposing of the US treasuries. No one is buying it anymore. And if there's a debasement of the dollar, why would anyone buy an asset type, a bond, which might pay for, but then is losing its value? There's no interest. The whole point of buying the dollar is that it was a very solid, and it was the reserve currency, so there was confidence in the strength of the dollar, but that's no longer the case. So we have we have the structural deficits, we have the countries increasing their gold reserves, we have countries disposing of US treasuries to build their gold reserves. We have a limited supply of gold, very limited. I mean, I'm talking about gold reserves that have been identified. And you may have heard recently that the US wants to invade Venezuela to deal with to deal with the drug cartel. But that's just a pure excuse, because if you look at all the countries that have gold reserves, most of them are BRICS. So the US doesn't dare invade them. Venezuela, I think, could be BRICS, but is more close by. I mean, the justification is the drug cartel, but in reality, Venezuela holds one of the largest reserves of gold. And of course, they want to get their hands on gold if they can. So yeah, central banks are buying more gold globally. China is buying more gold, but not reporting. I mean, there's a big question mark of whether they are fully reporting their purchases of gold. I think they have much more, as does Russia, than is reported in the press.
Yeah.
So they are increasing their reserves because, as you know, these BRIC countries, the plan is to issue their own BRIC currency, and it's going to be underpinned as the how can I say this, as the anchor for the new currency is going to be heavily weighted in gold. So um, and we have inflationary pressures still playing a part. I know that the indices are showing tame inflation, not quite target 2% inflation, maybe 3, but then there's a question mark of whether the components of this inflation index is true or not, and it's has been manipulated for political purposes. And yeah, I think precious metals are considerably undervalued to other commodities. I think we see parallels with the 1970s inflationary regime. They come in three waves. I think we saw first wave during COVID. We still have um, geopolitical risks which haven't eased. I think if you look at the drivers in 2026, 25, the geopolitical tensions in Russia and Ukraine, that is still ongoing. We've got Israel and Gaza, Palestine. We have escalating US-China tensions because of Taiwan, but then on trade. Um, then we've seen instability in the Middle East with Israel attacking all nations, even friendly nations like Qatar and Saudi Arabia. Saudi Arabia has last week signed a defense pact with Pakistan, which is a nuclear power, that if they attack Saudi Arabia, then they're attacking Pakistan, so they could come join any conflict. Global military spending is being ramped up. NATO and other countries, they fear that Russia may attack the Baltic states. Um, persistent inflation. Matt, in essence, you know, all the macroeconomic factors which we thought would drive the price of gold and silver to test 3,050 dollars an ounce of silver, they are still here and they are magnified. They've kicked the can down the road, but they haven't addressed the deficits. The problem is just being much worse, and naturally, the natural consequence of this is that gold and silver will go much higher than they are now. So, you know, our target of 3,000 was breached. It took more time. Some of our investors lost a bit of patience with us, but I think time has shown that we were right. And we split between gold and silver, and we had miners. Miners is a leverage on the price of gold of around 2.3, depending if it's mid-sized or junior gold miners. I'm not saying that miners are a good buy a big long-term hold, but during this brief period of the price going higher, I think the miners are going to do extremely well. And we were right in holding them. And look, where do we go from here? Um, it's so difficult to make predictions. But look, if you look at the M2 money supply as a measure, it's something we used during COVID when we were predicting a price of at least 3,000. If you look at the money supply, if the money supply historically is expanding, then gold will expand because you're debasing the dollar and the value of money, the value of the dollar. Gold is priced in dollar, then gold has to its fair value was around 3,000. I think now, based on the monetary base today, then a fair value of gold is in excess of $5,000. We already reached 4,400. There's no doubt in my mind that 5,000 will be breached in 2026. It's always difficult to predict when, but it will happen. Matt, it's a question of time, and I think silver will get close to 100. I generally believe that that's um, quite a realistic target. So our advice is to hold on. There's going to be a lot of volatility, undoubtedly. If the U.S. central bank starts lowering its base rate, then that is going to be a strong tailwind for gold and silver. No question about that. Um, yeah, in excess of 5,000 is entirely a reasonable target. And then the other thing I would say, because um, there've been developments um, in the last few weeks. You know, we talked about the 0.25% rate cut, but perhaps what's less noticeable is that the Federal Reserve decided to stop quantitative tightening. Remember, during COVID, we did quantitative easing, which is to create more money in the system, to flood the financial system with more money, which is inflationary. We knew that. And to keep the economy running. And then they decided to raise rates and to take liquidity out of the financial system to tame inflation. Yeah. But now they've reached the point where they're very cautious on lowering the base rate, but they've stopped the quantitative tightening. So whatever liquidity is in the system, in the monetary system, in the US financial system, it's not being drained out. So that is a sign of concern about, at least the Federal Reserve is concerned about the state of the economy. You know, we haven't had data for a while. I think it's been reopened now. Um, so yeah, that's really the major developments. I would say one other thing, Matt. I don't know if you've seen that, but a lot of the investment houses came out last week. I think if you look at on a global scale how much gold investors hold in their investment portfolios is like 1%, right?
Yeah.
And they should hold. I mean, I think one of the things we said they should be holding 5, and if they increase the exposure, then gold will go to 3,000 easily. Well, it's. I mean, in terms of there has been flows of investor monies into ETFs, gold ETFs. There's no doubt about that. But what's interesting, Matt, is that the last few days, the large US investment houses have come out and saying we no longer believe in the 60-40 portfolio. 60% equities, 40% bonds. You know, our model has changed fundamentally in this environment. Now we advocate 60-20-20. 16 equities, 20 in bonds, and yes, 20% weighting gold. This is not one. This is a few top US investment houses saying, we strongly recommend investors to hold 20. And remember, they're holding like 1%, and we were saying 5 years ago, hold 5. And they are going back to 20. That is what they are suggesting for their portfolios to deliver returns in this turbulent market, to increase their exposure to gold, which is quite a shift, and it's worth mentioning. So yeah, where does silver go? Well, it's trading at like 90 times 90 ounces of silver for 1 ounce of gold. Historically, it's been 50. I think there's going to be some compression there, regardless of what gold does. So silver has probably more upside. But look up, if you look at the market, the base case is, as I said, anywhere between 4,800 and 5,400. Silver anywhere between $70 and $85. The bull case is, more geopolitical tension, um, structural deficits remain in place, people shifting out of the dollar and increasing, central banks increasing their holdings of their gold reserves, which I think is going to continue. Private investors shifting their holdings into gold. I think in a bull case scenario, and yes, our probability is probably 25% max, but gold will get to 6,000 to 7,500. I've seen a lot of market commentary and say that probably a fair value is close to 6,500, and silver will get to 100, possibly 130. But look, even if you take the base case, there's still significant upside potential.
Yeah.
And frankly, I think 5,000, I would say, is a given, because it's like 12% away from 5,000. I think more realistically, we're looking at the possibility of 6,000. I think we haven't done any further research because everything is so fluid, but there's no reason why um, it won't hit those levels. Yes, if the dollar unexpectedly increases in value, then gold might retrace, so and underperform. How likely is that the dollar will strengthen when all the BRIC countries are disposing of U.S. Treasuries and buying the new BRIC currency? I don't think so. Too many people are disposing of U.S. Treasuries. A coordinated global disinflation strategy. Each country is have their own problems, structural deficits. They're trying to address it the best they can. They don't know how, because it's a bigger problem. So I think a more likely scenario would be that they continue building their gold reserves and then they revalue gold. Remember, gold in the books are valued at the initial purchase prices rather than current prices. So that might be a way forward. If there was some, peace agreements in the Middle East and, Russia and Ukraine, I mean, the evidence suggests that that is nowhere in sight. Um, NATO countries are increasing their military spend, so their deficits are getting larger. Um, and yeah, if interest rates were to stay high, but most developed um, most countries have huge debts which are growing and they can't afford to have higher rates, so interest rates naturally have to go down. Um, so Matt, our view, I think, remains pretty much the same. Um, Probably our outlook was a bit on the conservative side when we said dollars, the price of 1 ounce of gold would hit 3,000. We were very conservative. I know we were mocked and laughed at the time. And there were people saying that gold would get to 10,000. We were very conservative in our outlook based on the factors at play at the time. But now, I think looking at 2026, I think gold will will breach 5,000. I'll be very, very, very surprised if it didn't. And silver, I think, will get to 80 at least. But 6,000 is certainly within reach. So anyone holding gold, gold miners, silver miners, the advice is hold on. And for those who haven't invested, they should seriously considering having some exposure to gold and silver, because nothing has changed since COVID that indicates that this is going to ease anytime soon. And of course, these are not long-term positions, but we're living very strange times. And as you know, Matt, gold is the only store of value. And people saying Bitcoin had replaced gold, but I think the evidence suggests that gold is still the ultimate store of value.
Still king.
I still
Gold is
king.
still king. Good. Wonderful. That's great, Paul. I think I watched a YouTube video the other day, and the person was doing the video, and then halfway through he inserted a past video that he did. I wish we had the technical skills to this, and we could insert you talking. But maybe for the end of 2025, when we revisit this, we will learn for that. I think the other thing I need to add is that this video isn't investment advice, and anyone looking at this should speak to their advisor. If you are a client of ours, feel free to speak to us. If you're not a client of ours, why is that? And maybe, you should be speaking to us. But of course, everyone needs to do their own research, etc., etc. But that's great. So gold and silver, we'll be keeping an eye on that. I'm sure most of our viewers will. We'll be reporting back. So feel free to subscribe to our video where we'll be covering this again in the future with additional content in areas. Like, share, comment on our videos as well. Any final thoughts, Paul?
No, I would just tell our viewers that they should take advice from the big US investment houses who are coming out really strongly saying increase your exposure to gold. I mean, investment houses are notoriously negative, as you know, Matt, on gold. They're the ones driving the equity market higher, and they have a vested interest in holding equities and bonds. And for them to come out and say our model portfolio has changed in this environment to hold 20% in gold, that's a really, really strong message. Probably because they're front running and they've got exposure to gold. Quite likely, because that's how they do. They probably have some
Vested
leveraged
interest, yeah.
trades in that, but equally the message is quite strong. There's still mileage in holding gold and silver. This is we are the beginning of a cycle, and there's money to be made. Probably, there's no guarantee in life, but there's a good possibility that they can help enhance returns and take a bit of the risk of some other areas of the market, which is becoming pricey.
Perfect. Wonderful. Okay, well, thank you so much for that, Paul. Thank you for those watching, and we'll be back with another video very soon. Thank you. Goodbye.